All right, folks. So, welcome to this session of LTR here in FX Street. This is Mark de la Paz from FX Instructor. And for those who are not familiar with the way I do things, feel free to just post any questions, any concerns that you may have in the middle of the session or at any time you'd like to interrupt. Before we go on, let me talk about what is happening. So we all know that this Friday we will have the start of the Jackson Hole Symposium. Because of this Jackson Hole Symposium, the usual correlation plays that we have had from, say, the stock market and your currency market has actually been a bit spotty. We have had days where our stock market was selling off, and yet Euro and Cable and Aussie still went up. We have had a lot of instances where we had bad data out of the Eurozone, out of the UK over the last 3 weeks, and yet despite bad data, we still saw our Euros and GUs bouncing. So why is this? Well, I tend to point my finger to the Jackson Hole Summit, Jackson Hole Symposium over the weekend. As we said, this starts on Friday. Why such an emphasis in Jackson Hole? Is this a policy meeting? Not really. Jackson Hole Symposium is basically a time when central bankers in the U.S. and from the rest of the world, they get to meet for a confab, they get to talk about what's going on, they get to discuss their expectations with one another. Okay, it is not a policy setting. They don't determine interest rates during the Jackson Hole Symposium, but policymakers tend to make announcements, tend to release some info about their plans during this time. So, your Jackson Hole Symposium venue for policymakers to announce an idea, to open an idea, and see how the other policymakers would react. Your QE1, especially your QE2, was introduced during the Jackson Hole Symposium last year. So the thinking in the market right now is, if Bernanke is going to print more money, is going to adopt more quantitative easing, it will be announced in or on Friday at the Jackson Hole Symposium. We have to point out that last year, Mr. Bernanke did not exactly say during Jackson Hole Symposium that I will do QE2. What he did during the symposium was outline the options that the Fed is looking at on how to fix the economic problems then. Now, this time, however, people are really thinking that Bernanke will announce something. We will get $500 billion of freshly printed money. If you ask one of the former MPC members, David Blanchflower, earlier in an interview he said, you know what, I think the U.S. needs $2 trillion. Of course, most people right now are thinking, maybe if there will be such a QE program, if there's going to be quantitative easing 3, maybe we're going to get $500 billion of fresh incentives, fresh money. Now, I would point out that this is not a certainty that we will get a QE3 announcement. For one, Jackson Hole is not a policy meeting. Okay, it's a symposium. They get to discuss issues with each other, but they don't vote on what to do. So we also have to point out that of the FOMC members, 3 are actually against the notion of a QE3 program right now. They think that Bernanke is just babying the economy too much, that there is a natural slowdown happening, and you can pump in more and more money, but it goes nowhere. It doesn't generate new jobs. It just pushes inflation up. It just allows the stock market to going up, making the rich richer, but the man in the street does not necessarily have a higher pay because of QE3. So there's a big debate, in fact, whether it is going to happen or not. At the moment in the markets, bond markets or bond traders are pricing in that QE3 will happen. Your stock traders, at some days they agree that QE3 will happen. Some days they don't. Okay, you will know when there are days that they agree that QE3 will happen by the extent of rally that you get in the stock market despite the absence of good news. All right. So that said, again, the impact of our Jackson Hole Symposium, the impact of expectations that QE3 will happen, is that markets, whatever data comes out, whatever is going on, market has been dumping the US dollar. Okay, so people have been more readily dumping the dollar. But from a technical picture, it is not as easy as closing your eyes and pulling the trigger on a buy in your euros, in your GUs. And let me show you why. If you look at your daily picture, notice that, okay, let me zoom in a bit. If you look at your daily chart in cable, notice that you've had a lot of long wicks in your charts, suggesting that at some point on an intraday basis, bulls were in control, only to let go of their control of the market. Now, other issues that we have to remember, we've already heard from Finance Minister Noda in Japan. And what did he say? He said that the Japanese stand ready to intervene in the forex market. He bragged about his 100 billion pool for intervention. And what happened? You did get a knee-jerk spike when Noda started talking, but afterwards our dollar yen actually sold off. Let us point out, guys, that at the time of Isuke Sakakibara, the last vice finance minister who was effective in controlling the currency, the size of the forex market then was something around the tune of what? I think at that time, during Sakakibara's time, forex trading was merely 1.2 to 900 billion to 1.2 trillion. Forex is now a 4 trillion market. So 100 billion sounds big, but okay, since we're talking about interventions, let me just open your dollar yen chart. Imagine, in order to spike your dollar yen from about 7,700 to 80, it took 50 billion for the Japanese to do this big white candle in our daily chart. The cost of that, 50 billion. And yet, how long did prices stay elevated? Less than a day. We quickly pulled back from 80. We quickly pulled back by about 150 pips. So what am I saying? 100 billion sounds big. I guess it is enough to prevent any collapse in dollar yen, but it is not enough to actually reverse your trends in dollar yen. As we said, when NODA started talking, your USDJPY shut up, only to reverse itself afterwards. By the way, there's a gap in my data for my charts, broker problem, so we'll have to deal with that. Alright, so as far as Japanese intervention is concerned, then it could happen, but we don't think that it would be sustainable. By the way, we think that any intervention or any effort at sustained intervention would probably happen only in September, the last month of the first half of the fiscal year for Japan. During that time, you will expect that corporate Japan will be sending money back home, and it would be better for them if the yen was weaker once they start sending money back home. In fact, last year, the Japanese actively intervened only in that September period to help corporate Japan. So guys, we're not planning to take trades in dollar yen, but just a reminder, we already know the budget for intervention. It's 100 billion. It's enough for, I guess, a week's worth of intervention, considering what we have seen before. Let me point out that on any single trading day, about 350 to 400 billion dollars worth of yen gets traded. So 100 billion is not enough to sustain, to even think about sustaining USDJPY at a higher rate for more than a week. Alright, so we are not planning on doing anything in dollar yen. Where should we move? Let's take a look at euro. What do we have in euro? We find ourselves with buy signals from our daily indicators. We find ourselves with a good resistance from your high at 45.33. So effectively, what I'm trying to say is, when I look at euro, I tend to think, I know there are problems in the eurozone, but that looks bullish to me. Existential risk right now is present, but existential risk is not something that people are thinking about at the moment. People are thinking about quantitative easing. By the way, last year when we first heard about QE2, over a 3-month period, we saw how much? Over the first 3 months following that announcement of the QE option, we saw our EURUSD rallying from the 2700 area, 2600 area, all the way up to your 4200 price point. So we had 1,500 pips of rally in euro in a 3-month period following that QE3 announcement last year, which is what markets are looking for now. They're thinking, are we then going to push to 1.6 once we hear that the US is planning on adopting QE? Depends on just how much QE we get. As a reference, last year we had a 600 billion QE. This time around, the market is talking about maybe doing a $500 billion, 500 billion. So we look bullish. We have strong resistances at 45.33. But if we can confirm that quantitative easing will indeed happen, then our gauge would be that 1,500 pip rally that we saw last year. Now, intraday, what can we do in Euro for the moment? We know that we're bullish in the big picture. How are we looking from the lower time frame? Well, in 4-hour charts, we have a bullish crossover in MACD. Your stochastic also has a new bullish cross. You bounced off your EMA line. Your immediate resistances are, for the most part, minor. Your 44.99 area, previous swing high. Again, our strong resistances are at 45.33. Let's look at this from the hourly picture. And what are we getting? Hourly charts also has a confluence of buying. This is strange. Technically, your last hour gave you a bear candle. Technically, we actually have a dark cloud cover in our hourly charts. Normally, I see something like that, I would be saying, ooh, it's time to short. It's time to look for a sell-off. Time to look for a bear market. But that is under normal market conditions. And right now, we are far from normal conditions. As we said, at the moment, the main issue is we have a QE announcement expected. So, despite my dark cloud cover, what I probably would be telling you now is, oh well, let us see if your euro can give us a pullback later on. I'm not hot about the idea of pulling a sell just because I have a dark cloud cover. But if it does take me to a better price, if it does give me your 44.07 or 43.99 region, then perhaps I can do something. I can consider looking for a buy from that pullback point, from that 38.2 fib. So, we have a bullish hourly setup. We have a bullish set of indicators from the 4-hour chart. Our price action is giving us a bear signal at the moment. Normally, I would have preferred following that dark cloud cover signal, but because of quantitative easing issues, I would say allow for a pullback, but let's buy from some form of support. Sure, Ghana, we'll do that after this. What is QE announcement? Soleiman, I hope I'm saying that right. We basically have, or rather, we expect that the chairman of the Federal Reserve, Ben Bernanke, will be talking about a quantitative easing program in this Friday at the Jackson Hole Symposium. Last year, he opened the idea of quantitative easing 2 during the Jackson Hole Symposium. So people are now thinking that he will do the same this year. Use the Jackson Hole Symposium to float the idea that he will print money. When you talk about quantitative easing, you're basically saying that a central bank is printing money. Okay? Quantitative easing is when your government is printing money to pay you for whatever services that you've rendered, to pay you whatever it owes you. Okay? To do that, a central bank would print money, and your the government, the treasury, will borrow that money that's newly printed from the central bank. Well, Arashega, if there is QE3, I won't, if it happens, forecast of getting to 25, I think, is highly plausible if it happens. If there's no QE3, I would look for a sharp pullback. Let me take a look at your gold chart. Oh, we can't switch screens. I didn't just recording this, so let me just move this platform here. And what do we see in gold at the moment? We had a high at 1915. If there is QE3, I would expect that we could easily go to 2000, and I will not discount the possibility of getting to 2500 if we get QE. Let's take a look at what happened last year. There you go. We were around 12,000, 1,200 in gold at the start of September. Okay, when QE was when the idea of QE was announced, we went up from 1,200 all the way up to your 1,400 area. Over a 3-month period, we congested for a while under 1,400. Now, don't think of it in terms of dollars. Think of it in terms of percentage. So you're talking about a 25% upswing in gold prices following the announcement of QE2. So, at the minimum, I would say wherever we are, I would look for 2,000, but we could be talking about getting to 2,300, 2,400, maybe even 25, where a lot of your more extreme forecast for gold is right now. But that is if we have QE, if we have quantitative easing 3. Again, quantitative easing would force a lot of people to seek the haven, seek the safety of holding on to gold. Now, if there's no QE announcement, we've already pushed up by what? For the last 3 weeks, we've pushed up by about $300. So I guess a sharp pullback at least to 1,600 would be something that we can look for if there is no QE announcement. Pull back to 1,600. So that's it as far as gold and QE is concerned. Let's take a look at EUROCAD for Ghana. Excuse me. What do we have in EUROCAD? If you look at it from a big picture, daily chart, we actually had a breakout yesterday, so we should be thinking about a further rally. We've got good resistances around your 43.78 price point. Okay, so nice resistances at 43.78. Indicator wise, you are coming off overbought territory in stochastic, but that's okay. Whenever we have a breakout, it's okay if we pull back from overbought levels, as long as we remain above our breakout point. So we need to stay above 42.53 for the day. We go intraday, and what are we getting? So let me just adjust this to 42.53, our daily level breakout point. There we go. Intraday, what are we getting? Your MACD is flat, your stochastic has a bullish cross. Anything from the candles? Well, I don't see anything special about your 4-hour candles here. Although we do have a bullish bias in the works. Looks like 42.53 makes a good support level. Let me see this from the hourlies. So nothing special about the 4-hour candles. Mixed candles for the most part, although there's a hint of bullish bias from the indicators. From the hourly picture, we have our stochastics crossing lower, our MACDs at risk of crossing lower. Here's what I'd like to do. It looks like we are pulling back towards the breakout point at 42.53. We've bounced off it before, so I would look for a bounce off it again. We can look for possible buyings from just above 4253. We can use a tight stop under that. We can put a stop loss around your 4240 area, or maybe 4230. And your objective, initial target would be to continue playing this congestion. Initial objective would be to try to just get to the 4300 level. So you're talking about maybe a 50 pip move, but we may get some more. We may be at the start of the next up leg, a push towards your 4378 price point. So we have a bullish bias in EUROCAD. I think we've done a good breakout on the daily scale. The question now is, can we retain that strong rating that we have had for EUROCAD? Ghana, I'm using a simple stochastic, fast stochastic, 533. Okay, let's take a look at Aussie and then dollar CAD. Aussie, what do we have? I started the week with a bearish bias, but because of our close yesterday, I think there's significant risk of a break of your daily EMA lines. There's now a significant risk of us pushing past last week's highs at 106.01 and really rallying towards your 107.90 area. I think of 107.90 as a good strong resistance level. For a while we were contained by that 107.90. Acted as a good nice resistance before. So strong resistance is at 107.90. Our daily indicators tells us that the risk going forward is for further gains to push above your daily EMA line. Now, move to lower time frames, and what are we getting? 4-hour charts, we have mixed signals. MACD's up, stochastics dropping. Nothing from the candles at the moment. Although this could potentially end up a piercing pattern in the 4-hour picture. My 4-hour candle will be closing at the end of the hour. So we have prospects of a piercing pattern, a bullish signal. Let me go hourly. From the hourly level, we have our MACDs crossing lower. We have our stochastics setting up. Mixed signals. Candlesticks as well are giving us mixed results. So I am not particularly keen about doing anything in Aussie at the moment. Although I tend to think that it is a buy on dips market. If you look at your hourly charts, you have steadily seen higher lows and higher highs since last week in the hourly level. So I'd like to take advantage of that. Any dip that we get to the 104.55 area, I would say a good enough buy. The objective is to finally have a trading day where you close above the 55-day EMA, where you close above the 105.77 threshold. So Aussie, we look at this as bullish. By the way, we do have data coming out. And what is this? We have, so let me get the calendar. Later we will be seeing durable goods orders numbers and durable goods orders headline figure out of the US. The core data is expected to turn out minus 0.2. Your headline data is expected to come out 2.1%. If we have both numbers coming out as expected or better, I think it would be a good argument for expecting our Aussie to push higher. When it comes to US data and your commodity currencies, the Aussie, the Canadian dollar, normally when you get good US data, especially in something like durable goods, then we would expect that Australian exports will improve. So a good, strong durable goods orders numbers from the US will have a positive impact for your Aussie. So hopefully we don't disappoint, and we do get good, strong durable goods data, if not better. So Aussie, again, we look bullish, but watch out for data. How good the data is will tell us how aggressive we should be for the buy side of Aussie. And that goes for your dollar CAD as well. Strong durable goods orders numbers would probably mean a lot more exports to the south. And a lot more exports by Canada to the south would mean its balance of payments would improve. A strong balance of payments will also strengthen the currency. So your dollar CAD could potentially sell off if you have good AUD, if you have good durable goods orders numbers later on. Let's take a look at specifics for dollar CAD. Well, we haven't quite gotten a weekly close above 99.10 still. So we are right around our breakout point in USDCAD. Okay, looking for a weekly level double bottom to get triggered. So one of the things that we would want to see is, can we get a weekly close? Alright, this is a good example for this, a good chart for example. Okay, let me finish what I was talking about. When we have, if we get a weekly close above 99.10 in dollar CAD, we can argue that a double bottom has been triggered. So we can tell ourselves, expect a sustained rally. Although I tend to think your sustained rally would probably find itself with problems once it gets to the 102.60 area. So this is something that we're looking for, a weekly close above 99.10. What has surprised me is this. Normally, strong resistance like this, 99.10, and a failure to take it out would probably see you selling off again. And yet we have none of that. For the last two attempts that we have failed to close above 99.10, we merely eased off below 99.10 but never really saw a big sell-off. So at the moment, what can we say? Well, you now have a strange congestion from the 97.77 area to the 109 psychological 1009 100 psychological resistance level in your dollar CAD. Within that, you currently have sell signals, but EMA lines are pushing higher. And when you look at your chart, you have long tails. Because of these long tails, I tend to have a bullish bias, although I don't have my weekly close above 99.10 yet, which would really make me happy. So, signal-wise, your dollar CAD is mixed from the big picture. Your MACDs, your stochastics are dropping. Your price action is telling you, look for a rally, look to push past 99.10, look to stay above 99.10. Intraday, what are we getting? A confluence of bears in the 4-hour picture. And more confluence of bears from the hourly level. So from the looks of it, dollar CAD's immediate risk is to actually ease off. Look for a test of our congestion floor at 98.26. Maybe even a test of your key support around the 97.77 region. Now, what is the significance of a long wick in the candlestick? Look at your dollar CAD daily chart. You have had a lot of instances where you had long wicks. A long wick basically tells you that market was bullish. Yet all of a sudden, bulls pulled back, bulls stayed out of the market, and allowed bears to gain control. Normally, if I see a long wick and we had an uptrend before that long wick, I tell myself we have hints of a reversal. Okay, so long wicks preceded by an uptrend suggests that we could potentially get a reversal of your uptrend. So long wicks are important, particularly with respect to the preceding trend. If you had a sideways market and you had a long wick, it's meaningless. If you have a bearish market and you have a long wick, it tells you expect a boost in bearish sentiment. Alrighty, folks. So, any other questions for me? Any chart you'd like us to look into? So, long wicks are a sign of bears trying to wrest control of the market. Alright, guys. Before I go, let me just take a quick look at our EURGBP. I see. Your euro pound remains stuck in this ranging action. What's the significance of this for us? Simply put, that as long as we see our EURGBP pushing for our resistance, we risk our we are likely to get our euro even more bullish than your cable. So if you're given a choice between buying euro and buying GBP, and you see that EURGBP is pushing, for the moment we have had our EURGBP stuck in this ranging action. we are headed for 8807 and then 8848. While we're doing that, you would expect USD will be able to hold on to gains, will be able to sustain any attempt at a rally. What I meant was, if you have your euro pound continuing to push up, you have risk appetite in the market. Basically, euros going up, GU's going up, Aussies going up, dollar yen's going down, USDCAD's going down. Under those conditions, you're asked to choose only one trade. Do you buy euro or do you buy GU? My answer would depend on what's happening in euro pound. If euro pound is also rising, then I will buy my euro, expecting that I will get more upside in EURUSD instead of GBP USD. So what I'm trying to point out is that you should look at the crosses for a possible multiplier effect. Oh, by the way, looks like your dark cloud cover is finally having an impact in euro. But as we said, given market assumptions right now, any attempt at the pullback that we get in euro will simply be for us getting to potentially better entry points for buys in EURUSD. Guys, questions for me? So your dark cloud cover is looks like it's going to get a follow-through pullback after all. But our plan is to actually look for a bounce once we get near the 4400 area. Okay. Because of Jackson Hole's because of the speculation ahead of the Jackson Hole Symposium this Friday, we prefer a buy and dips approach when it comes to your dollar pairs. We prefer looking for a weaker dollar going forward. Alrighty guys, questions? Otherwise, if there are none, I will thank you for joining me, and I will wish you luck trading the markets. Just don't stay for too long on any trades. We've had a very rough time holding on to positions overnight lately. Oh, good. Go ahead, Vishal. Thanks, Rob.